Are you in a stage of life where you're building wealth? Or maybe you're on the other end of that and you've already got wealth, but you're looking to create income from it. No matter the scenario or the stage of life, you're most likely going to be using two of the three acronyms we're going to be covering today. And in keeping in line with our month of May of three-letter financial acronyms, we'll be looking at an ETF, what's an EFT, and how in coordination they can be used to DCA. Let's jump right in. Now first, let's take a look at an ETF, or an exchange traded fund. Now this is just a basket of investments. This could be either stocks, all bonds, or maybe a mixture of both. And this gives you instant diversification by owning hundreds of companies in just one purchase. This trades like a stock, or what's considered intradaily, meaning you can buy it at 10 and sell it at 2. But this behaves like a portfolio due to the diversification. Now the common mistake that I see here is understanding what you own and the fees that are associated with that. Where I see this the most is high income producing ETFs. Folks only pay attention to the income it's creating and not the fee that they're being charged or how they're creating the income inside the ETF. This can create misrepresentation of risk in the position. So a good action step is look at the ETF holdings. What do you actually own? Second, let's talk about an EFT, or an electronic funds transfer. And this is simply just moving money back and forth from your bank to your investment account or vice versa. This is used also in payroll deposits, automatic transfers, etc. There is no investing component to this. It's just money movement. So what I always recommend is set up connections between or automatic transfers between your investment accounts and your bank for easy access and automation. Third is DCA, or dollar cost averaging. And this is where your approach is going to split depending on your stage of life. So for my wealth builders, we'll use dollar cost averaging, or DCA, to invest consistently over time, allowing us to smooth market ups and market downs, and removes the pressure of timing the market perfectly. Because the thing that I see here, that's the mistake, is waiting for this perfect moment to invest. So automate your contributions and stay consistent. And when you put these three together, you get a simple system. Your money moves automatically through EFTs into investments, could be ETFs, on a consistent basis, or dollar cost averaging, DCA. For my income creators, you may be invested in ETFs and use EFTs to deposit funds into your bank account. But when it comes to DCA, or dollar cost averaging, this should not apply to you. Taking money out while markets fluctuate introduces a sequence of return risk. You need a withdrawal strategy that balances preservation, creates income, and has a little bit of growth. So taking withdrawals from the wrong positions during a market downturn can lead to ruin. So work to create a plan to sequence withdrawals for stability. There is a future video that will be discussing a strategy for creating sustainable income. But whether you're building wealth or drawing income, the key is a repeatable, intentional, automated system tailored to your stage and your needs. So if you're building wealth or you're creating income from your wealth, you both need to know what you own in your ETFs, and you both need to move your money automatically via EFTs. For my wealth builders, we'll use DCA, or dollar cost averaging, to build a simple, repeatable system to invest over time that reduces emotional decisions and puts compounding to work. For my income creators, we're going to stay away from dollar cost averaging. This is not a withdrawal strategy. This is going to avoid sequence of return risk that will give you confidence that your money will last even in volatile markets. So no matter what the stage you're in, I'll be glad to help you create a repeatable, automated system. Next week, we'll dive deeper into RMDs, QCDs, and DAFs. How to plan withdrawals, reduce taxes, and give strategically so your money works for you and for your favorite causes. We'll see you then.